The shock did not begin with a speech or a handshake. It began with silence. Screens flickered across trading floors, in policy offices, and inside quiet government corridors as reports surfaced that a staggering $780 billion in projected investment flows were being redirected toward China. Within minutes, whispers turned into headlines. Within hours, those headlines carried a single explosive question: how did this happen, and who saw it coming? At the center of the storm stood Donald Trump, reportedly blindsided by the scale and timing of the move, and Mark Carney, the architect many believe recalculated the global chessboard with one decisive shift. The number alone felt surreal. $780 billion is not a routine adjustment. It is not a marginal policy tweak. It is a structural tremor capable of bending trade routes, rebalancing supply chains, and sending smaller regional economies into a tailspin. Analysts scrambled to decode the implications. Was this a strategic diversification? A political message? Or the opening move in a broader economic realignment that could redraw alliances across the Pacific? For Alaska, the fear was immediate and visceral. The state's economic lifeblood has long depended on energy exports, federal investment, and geopolitical positioning. If capital and long-term contracts pivot toward Asia's largest market under new terms, where does that leave a region already sensitive to commodity swings and federal budget debates? Local leaders spoke in cautious tones, but behind closed doors the concern was sharper. Reduced demand, shifting infrastructure plans, and uncertain pipeline commitments could ripple through jobs, housing, and public revenue. In Washington, the mood was different. It was not panic at first. It was disbelief. Insiders described a moment of stunned calculation, as advisors tried to determine whether the redirection represented a symbolic gesture or a binding financial reality. If even a fraction of that capital translated into long-term agreements favoring Beijing's strategic priorities, the geopolitical consequences would be profound. Trade leverage would shift. Energy negotiations would harden, and America's northern frontier could find itself squeezed between ambition and uncertainty. The psychological impact may be as significant as the financial one. Markets do not only react to numbers, they react to narratives. The narrative forming in real time suggested momentum. Momentum toward China. Momentum away from traditional North American integration. Momentum that implied confidence in one economic orbit and skepticism about another. When investors sense momentum, they amplify it. When political leaders sense momentum, they must either counter it or redefine it. Critics argue that the move exposes vulnerabilities in cross-border coordination. Supporters counter that diversification is rational in an era of volatile trade politics. Yet the raw optics are undeniable. A headline figure this large sends a message, whether intended or not. It suggests that global capital sees opportunity elsewhere. It implies that stability, predictability, and growth prospects are being recalculated under new assumptions. For Trump, the stakes are layered. Economic strength has long been framed as proof of strategic leadership. A sudden pivot of this magnitude challenges that framing. Even if the mechanics of the shift were years in the making, the timing fuels perception. Perception fuels markets. Markets fuel political capital. The chain reaction is swift and unforgiving. Meanwhile, Carney's reputation as a steady technocrat adds intrigue. Known for measured language and disciplined economic reasoning, he rarely telegraphs dramatic gestures. If this redirection was indeed deliberate, it signals deep conviction about where long-term value lies. Such conviction is not formed overnight. It grows from data, projections, and risk assessments that may diverge sharply from the assumptions circulating in Washington. Alaska's vulnerability lies in its scale. It is strategically vital, yet economically concentrated. Energy accounts for a significant share of revenue. When global buyers shift preferences, even marginally, the effects can cascade. If Asian demand patterns change in response to new capital flows, infrastructure planning in Anchorage and beyond could stall. Projects built on anticipated partnerships might need renegotiation. Confidence, once shaken, takes time to rebuild. Across the Pacific, the symbolism resonates differently. China has spent years positioning itself as a magnet for long-term investment, particularly in energy transition, technology integration, and large-scale infrastructure. A commitment approaching $800 billion, whether direct or structured through layered agreements, reinforces that image. It suggests that the gravitational pull of its market is not weakening, but strengthening. Yet the story is not simple. Economic shifts of this magnitude are rarely absolute. They unfold in phases through contracts, memoranda, financing vehicles, and political understandings. The headline number may represent projected flows rather than immediate transfers. Still, projections shape expectations. Expectations influence behavior, and behavior determines outcomes. Inside policy circles, another question emerged. Was this a reaction to volatility in U.S. trade rhetoric, or a proactive bet on Asia's growth trajectory? If it was reactive, the implication is vulnerability. If proactive, the implication is strategic foresight that others failed to anticipate. Either way, the effect is destabilizing. Markets hate uncertainty, but they also crave direction. The moment direction appears to shift, capital accelerates toward perceived stability. That acceleration can compound disparities. Alaska's leaders now confront a dual challenge: reassure investors while lobbying federal partners for clarity. Without clarity, hesitation spreads, and hesitation in capital-intensive sectors can freeze development for years. In political terms, the optics are combustible. Opponents frame the shift as evidence of eroding influence. Allies frame it as routine diversification, mischaracterized for dramatic effect. The truth likely lies between extremes, yet nuance rarely dominates breaking news cycles. The image of a stunned Washington facing a bold recalibration is powerful, and power in politics often begins with imagery. What makes this episode particularly intense is timing. Global supply chains are already under strain from technological competition, energy transition pressures, and regional conflicts. Adding a headline figure that large into the mix amplifies existing fault lines. It forces leaders to clarify positions sooner than planned. It pressures negotiators to accelerate talks. It narrows room for ambiguity. For citizens in Alaska, the debate feels less theoretical. It translates into concrete anxieties about employment, investment, and public services. If revenue projections decline, state budgets tighten. Infrastructure upgrades slow. Community confidence wavers. Economic shifts may be global in origin, but their consequences are local and immediate. The administration's internal deliberations, according to observers, revolve around response. Should there be counter-incentives to retain capital? Should trade frameworks be adjusted to restore competitiveness? Or should the narrative be reframed entirely, emphasizing resilience and domestic opportunity? Each option carries cost and risk. Carney's camp, by contrast, projects calm. Diversification is prudent, they argue. Engagement with China does not negate partnerships elsewhere. Global finance is not a zero-sum game, yet critics respond that scale transforms nuance into signal. A move measured in hundreds of billions cannot be dismissed as routine. The geopolitical layer deepens the tension. Energy routes through the Arctic are increasingly strategic. Alaska sits at that frontier. If capital realignment influences Arctic development priorities, the strategic calculus extends beyond economics. It touches security, navigation rights, and long-term resource access. Observers note that economic power often precedes diplomatic leverage. When investment patterns shift, alliances adapt. If China secures expanded influence through capital commitments, it strengthens its hand in negotiations spanning technology standards, environmental frameworks, and regional security dialogues. That prospect alarms policymakers who view economic integration as a pillar of strategic balance. At the same time, overreaction could exacerbate instability. Markets punish impulsive responses. Measured strategy requires composure, data, and disciplined messaging. The question is whether political cycles allow for that patience. The human element should not be overlooked. Behind the figures are executives, workers, and families. Decisions taken in boardrooms ripple outward. A refinery expansion delayed in Alaska affects contractors, suppliers, and small businesses. Confidence, once shaken, can be difficult to restore without visible commitment. In the days following the announcement, volatility crept into related sectors. Energy stocks fluctuated. Shipping projections were revised. Analysts debated whether the $780 billion represented immediate allocation or multi-year projections contingent on regulatory milestones. Each interpretation carried different implications. For Trump's political brand, the challenge is narrative control. Economic nationalism rests on the promise of domestic strength and strategic leverage. A high-profile pivot abroad challenges that storyline. Reasserting confidence requires not only policy adjustment, but persuasive communication. Carney, meanwhile, occupies a different rhetorical space. Framing the move as pragmatic, forward-looking, and data-driven positions him as a steward of long-term stability rather than short-term optics. That contrast intensifies the drama because it pits emotional reaction against technocratic recalibration. Ultimately, the central question remains unresolved. Is Alaska truly on the brink of economic collapse, or is this a recalibration that will settle into equilibrium? Catastrophe narratives attract attention, but structural economies adapt. The coming months will reveal whether capital flows materialize as projected or whether negotiation reshapes their trajectory. What is undeniable is that the psychological shock has already occurred. Confidence has been tested. Assumptions have been challenged. The perception of inevitability surrounding North American integration has cracked, if only slightly. And in global finance, even a crack can widen under pressure. The story continues to unfold in layers, each revealing deeper complexity. Beneath the headline lies a contest of models, one emphasizing diversification across global growth centers, the other emphasizing concentrated national resilience. Both claim rationality, both claim foresight. Only time will determine which proves more durable. As markets close and reopen, as statements are refined and clarified, the tension remains suspended. $780 billion is more than a number. It is a signal flare in a world already searching for direction. Whether it marks the beginning of a seismic shift or a dramatic but temporary adjustment depends on choices yet to be made. Part 2. In the aftermath of the initial shock, attention shifted from the headline to the mechanics. How exactly would such a vast sum move across borders? Through sovereign funds, private equity channels, infrastructure bonds, long-term energy contracts, or blended financing vehicles designed to mitigate risk? Each pathway carries distinct timelines and contingencies. The complexity itself tempers panic, yet it also underscores the seriousness of intent. Large-scale capital allocation is rarely impulsive. It is structured, negotiated, and insulated against volatility. Strategists began mapping scenarios. In one, the projected funds catalyze renewable infrastructure, advanced manufacturing, and logistics corridors aligned with China's growth strategies. In another, geopolitical tensions slow approvals, reducing the headline number to a fraction of its potential. The range of outcomes is wide, but even conservative estimates imply meaningful rebalancing. Alaska's policymakers face a strategic crossroads. They can double down on attracting alternative investment, leveraging Arctic routes and resource development to offset uncertainty. They can pursue deeper domestic integration, seeking federal guarantees to stabilize revenue streams. Or they can attempt to re-engage Asian partners under revised terms, competing within the new landscape rather than resisting it. Economic historians remind us that capital has always flowed toward perceived efficiency and opportunity. When Britain dominated maritime trade, investment followed. When post-war America built industrial supremacy, capital gravitated there. Today, Asia's scale and growth potential present a compelling magnet. The redirection of funds may reflect structural evolution rather than political rebuke. Yet politics cannot be disentangled from economics. Statements exchanged between leaders influence investor confidence. Regulatory signals alter risk premiums. If rhetoric escalates, capital hesitates. If diplomacy stabilizes, flows resume with greater clarity. The delicate dance between assertion and accommodation determines whether tension hardens into division. Within the United States, debate intensifies over competitiveness. Are regulatory frameworks agile enough? Are incentives aligned with emerging industries? Is infrastructure modernization keeping pace with global standards? The shock of a potential $780 billion shift acts as a mirror, reflecting strengths and weaknesses alike. Public reaction oscillates between alarm and skepticism. Some question whether the figure has been exaggerated for dramatic effect. Others argue that even partial implementation could reshape trade balances. The truth lies in documentation and follow-through, which unfold far from cameras, yet determine long-term impact. Meanwhile, China's economic planners are unlikely to ignore the symbolism. Securing high-profile commitments enhances credibility in global markets. It signals that despite geopolitical friction, major capital actors remain willing to engage. That signal can attract additional partnerships, compounding influence. For Trump, recalibration may involve reframing the narrative around resilience and domestic reinvestment, emphasizing energy independence, technological innovation, and workforce development could counter perceptions of vulnerability. Political survival often depends less on preventing shocks than on redefining them. Carney's position, by contrast, may hinge on demonstrating prudence. If returns materialize and partnerships stabilize, the move will be vindicated as foresight. If complications arise, critics will label it overreach. Leadership in financial strategy carries asymmetric risk. Boldness invites scrutiny. Alaska's communities watch developments with pragmatic concern. Fishermen, engineers, port operators, and public servants understand that macroeconomic shifts eventually filter down. Their resilience is rooted in adaptation, yet adaptation requires time and clarity. Uncertainty erodes both. There is also a strategic Arctic dimension. Melting sea routes and resource exploration intensify competition for influence in northern latitudes. Investment patterns shape infrastructure, which shapes control. If capital priorities shift toward alternative corridors, Alaska's leverage could diminish unless counterbalanced by targeted policy. Global markets, however, are not static chessboards. They are ecosystems of competing incentives. If the United States responds with innovation incentives, streamlined permitting, and diplomatic recalibration, capital may rebalance again. $780 billion projected does not guarantee permanence. It represents intention contingent on stability. The emotional intensity surrounding this episode reflects broader anxiety about transition. The world economy is moving from one era to another, from fossil fuel dominance toward diversified energy portfolios, from unilateral supply chains toward multipolar networks. Transitions generate turbulence. Turbulence generates headlines. In quieter moments, economists caution against binary thinking. Engagement with China does not preclude partnership with America. Diversification spreads risk. Over-concentration invites vulnerability. The challenge lies in managing perception so that diversification is not mistaken for abandonment. Media cycles, however, thrive on drama. The image of a stunned leader juxtaposed with a decisive technocrat is compelling. It personalizes structural shifts. It frames economics as confrontation. Yet beneath personalities lie spreadsheets, projections, and demographic trends driving decisions. As weeks pass, concrete indicators will matter more than rhetoric. Are contracts signed? Are funds allocated? Are joint ventures launched? The answers will determine whether the initial shock evolves into sustained transformation or fades into recalibrated equilibrium. For Alaska, contingency planning becomes essential. Diversifying revenue streams, investing in renewable sectors, and strengthening local entrepreneurship could mitigate dependency on external capital. Economic resilience is rarely built overnight, but shocks often accelerate reform. At the federal level, bipartisan recognition of strategic competition may spur policy innovation. Investment in advanced manufacturing, semiconductor production, and clean energy could attract global capital back toward American shores. Competition, when channeled constructively, can stimulate renewal. Carney's gamble, if it is one, rests on confidence in long-term Asian growth. Demographics, urbanization, and technological adoption trends support that thesis. Yet geopolitical friction remains unpredictable. A single diplomatic rupture could alter projections dramatically. Trump's response, measured or forceful, will shape domestic and international interpretation. If framed as a call to strengthen competitiveness rather than escalate tension, it could reassure markets. If framed confrontationally, volatility may deepen. Ultimately, the fate of Alaska does not hinge solely on one capital shift. It hinges on adaptability. Resource-rich regions worldwide have navigated cycles of boom and contraction. Those that diversify and innovate endure. Those that rely on static assumptions struggle. The narrative of collapse captures attention, but collapse is rarely instantaneous in complex economies. It is the product of sustained neglect or compounded shocks. Whether this episode becomes a catalyst for renewal or a precursor to decline depends on strategic choices now unfolding. Investors worldwide are watching not only the numbers, but the tone. Stability attracts. Uncertainty repels. Transparent communication from all sides can temper fear. Silence magnifies it. As the dust settles, a deeper realization emerges. Global economics is an arena of constant recalibration. No alliance, no capital flow, no trade pattern is immune to reassessment. $780 billion represents ambition, projection, and possibility. It does not represent destiny. The real story may be less about who was stunned and more about how nations respond to surprise. Resilience, innovation, and disciplined diplomacy often determine long-term outcomes more than initial shocks. Alaska's future, America's leverage, and China's expanding role will intersect in ways still unfolding. In the end, this episode serves as a reminder that economic power is fluid. It shifts with data, confidence, and strategic vision. Leaders rise or falter based on their ability to anticipate change and adapt. The world is watching to see which model prevails: reactive defense or proactive reinvention. The tension remains palpable, the stakes immense, the narrative unfinished. Markets will open again tomorrow. Negotiations will continue behind closed doors. And somewhere between alarm and opportunity lies the path forward, waiting to be defined by decisions made in the shadow of a headline that shook the global stage.